Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, March 14th, 5:20 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in a correction. You can see over here at the trend gauge, we track the market over 3 time frames, meaning where are the 5 major indexes versus their short-term 21-day moving average, medium-term 50-day moving average, and long-term 200-day moving average. Depending on the health of those indexes and how market leaders are acting, that dictates how much exposure we have to the market. Market leaders were showing some weakness over the last week, as has basically everything in the market, but still holding strong at neutral. Short term, 4 of the 5 indexes are below the 21-day moving average. NASDAQ 100 displaying some pretty good strength. Actually, not sure I've ever seen this before. We've got the NASDAQ 100 above all 3 of the major indexes and every other index below all 3 of the time frames. And all the other 4 indexes below all 3 of the time frames. And this has just been a case of money flowing into big, strong balance sheet companies, and away from financials, as the market's still trying to find its footing after the seizure of 2 banks and the banking crisis, bank run, liquidity issues, Fed bailout of clients' accounts, not of the companies themselves, but a lot of volatility still in the market. So we're showing downtrend slash bearish across the 21-day and the 50-day moving average, neutral versus the 200-day moving average. We will confirm all this. It'll make sense if you're new to us when we review these charts momentarily. So what happened today? One of the stranger days. Uh, CPI gap up in the morning. We gapped up 1.3% on the S&P, and continued to go higher. We were up over 2% at one point, and then ran into the 200-day moving average on the S&P and had a very hard fade. Pulled back about 1.6% off the top. Looked like the market rally of the day was completely fading. And then at 3:15, we had a hard squeeze into the close, 1.3% squeeze into the close into the last over the last 45 minutes. So 3 major trends throughout the day. The final numbers look good, but a lot of head fakes intraday. Let's say that. So the final numbers: G6 up almost 2%. This is our 6 ETF composite that we use to track small and mid growth stocks. We always want this on our side when we're putting money to work. S&P 500 end up 1.65%. NASDAQ 100 continuing to lead, up 2.3%. Dow up 1.1%. Mid caps up 1.9. Russell up 1.9. These are up well over 3% at one point before fading, along with the banks in late afternoon. Global Diversified 60/40 up 0.6%. In-house GROTECTION down 0.06%. Certainly one of the downsides of doing one of these videos every night and saying what our performance is you take the chance that you're going to look like an idiot if this is one of if people don't watch every video. So basically what ended up happening today is we came in lightly invested after the big sell-off the last 3-4 days, and our almost 300 basis point gain evaporated during the day, as we made 5 trades today. One winner, one scratch, 3 losers. We'll detail them when we get to reviewing what we did in the portfolio today, but basically gave back quite a bit of the gain that we garnered over the last 5 sessions, and that's part of it. It's expected. This is why I show this chart, what our expectation should be during various market conditions. We were in this mild correction. Now, inline performance certainly doesn't mean every day we're going to be inline performance. It means net net until we transition from one of these market conditions to the other, you'll see inline performance. But when you can see, plus 300 basis points over 5 days, and then you give it all back because once we hit the 8% area of a correction, that normally means we're under the 200-day moving average. Normally, a drawdown of 8% off of the high is about the limit to when we end up going to cash because our stops are getting hit and or the indexes are in an unfavorable situation. And that's where we ended up coming into today. A lot of it was due to the panic over the last 3 days, but um, you never know the panic. We draw the line, and I say it all the time, at this 200-day moving average between being very defensive and not, and that's because all these bear markets occur under the 200-day moving average. So our number one job is client account protection, downside protection, and then the returns take care of themselves when the market gets back to healthy. It's been a tough market off of the lows. A lot of a lot to deal with from an economic standpoint, geopolitical standpoint, but protecting the downside, preserving capital. We know how we can rally when the market gets to the correct posture, and we'll review this when we go through the indexes here and the charts of the stocks that we are focused on today. So let's dive into that. And we'll start as we always do with the S&P 500. So just looks here, looking at the chart, like, hey, nice day today. Rebound, closed near the top of the range. Let's dig a little bit deeper on this, and we'll look at a 5-minute chart. So here's the gap up 1.3%, rallied all the way up to 39.37. We tried to get above this for a good 30 minutes. Now let's go back to what that high means on a daily chart. The S&P 500 200-day moving average is at 39.40, so 3 points shy of it. That's also where the declining ADMA, that's the shortest term moving average that we use, but very often it stops short-term rallies in their tracks, and we want to make sure that we get above this before we're committing any more money to the S&P 500. So back to the 5-minute chart. So once we failed to get through that, then we had a pretty harsh sell-off from 39.37 all the way down to 38.80. Came in three waves, wave one, wave two, wave three, actually bottomed at 38.73 before this massive squeeze the last 45 minutes into the close, and we close at 39.20. Let's go back to the daily chart here. And basically below 0.3% below the ADMA. This is our sixth straight close below both the ADMA and the 21 EMA. We're looking for some confirmation of health back above those before we start putting money to work in the S&P 500. Now contrast that with the NASDAQ 100, which this is what we prefer the S&P 500 to look like. You've got, and this had its challenges during the day too. You see the gap up, the rally, three waves of a sell-off and a hard squeeze into the close. During the day, when we got above the 21-day moving average, we bought 2.5% QLD, and we also bought 1.5% SOX L, which is the enhanced ETF of semiconductors. Semiconductors have been leading for most of the year. They're forming this really nice 10% flat base over the last 5 weeks, bounced off the bottom range of it, this key support area at 400 during the sell-off over the last couple of days. Reclaimed the 8 and the 21 today. We put some money to work in there. So when we failed at the when it became apparent that we were failing on the S&P 500, and by apparent to me it was undercutting the 3900 area, rallying back above, and then making a lower low. We put a short on the S&P 500 within 1% of the high. So we're basically long the NASDAQ and semiconductors and short the S&P 500. One of those trades will win. And we'll wait for, it's kind of like a seesaw. We do this kind of frequently when different sectors or different indexes are outperforming one or the other, because eventually they usually, I say eventually, not there are no absolutes in the market, but typically they all end up rowing in the same direction. So the question is the Nasdaq 100 going to continue to lead and pull the rest up, or is there too much damage and uncertainty between the economy, interest rates, and the banks? And will that end up pulling the Nasdaq 100 down? Now, the one wild card in this is the fact that there are zero financials in the Nasdaq 100, and that's the main reason why it has accelerated on a relative strength basis over the last week. Note the relative strength line making a new high, and price not even near a new high. That's all the way up at 313.68, or this level right here. So the fact that there's no financials in the NASDAQ 100 means that there's no stocks that are going to get crushed, or indexes. Let's look at a bank index here, KBE, and how that has been sold off, or regional bank index, KRE, or even the broad financial index, XLF. Zero impact on the NASDAQ 100 because there are no financials in it. So uh, that's the explanation for why that has outperformed. And money just also flowed into those big NASDAQ firm balance sheet, strong balance sheet stocks, the big NASDAQ 100 stocks, as well as not having the financials being able to drag on it. And that's caused the outperformance of the NASDAQ 100, especially over the last week and a half. So that's where we are there. Let's continue on. Dow Jones Industrial Average, also below all three indexes, including the 200-day moving average. Nice bounce off of the lows there today at that 32,000 level. MDY tried to recapture the 200-day moving average, ended up closing just on it, or just slightly below it by the end of the day. But after those 3 nasty days sell off, this is really not that strong of a bounce. I came into the day, I don't predict, but I always have expectations coming into the day. And my expectation was that these bank indexes were going to get a very strong bounce higher. But let's look at a 15-minute chart of the regional bank index. We got the gap up, uh, and then we sold off all day with these financials. Some of these that had recently been beaten down were up 30, 40, 50% off of the lows. Schwab came out was one of the, it's where we custody our assets. Schwab came out and explained that why they have zero issues with what they're holding. The stock ended up over 9% on the day. The CEO chairman came on CNBC, said he bought 50,000 shares at the open today for SCHW, and it bounced nicely. This is kind of what I was expecting with KRE and KBE, but that's not what we got. It sold off all day after the initial gap up. So there certainly is continued weakness in the financials. And with financials being, I believe, the second largest component of the S&P 500, that's going to drag down the S&P 500. And that's one of the reasons why it hasn't been able to get back above the 200-day moving average. So those are so we showed the 5 major indexes. Let's go now to the dollar. Dollar didn't seem to play much of a role today in what was going on with the indexes. Kind of a tight range under the 21-day EMA. Normally, this dollar action would over the last 4 or 5 days have been a big benefit to stocks, but we've totally been outweighed by the uncertainties over what's going on with the banks. The VIX, after a massive 3-day spike, gave back quite a bit today, back down 10.7%, still above the 21-day moving average, but back below this 25 level, and seemed to act more normal, or get back to more normal levels after the 2-day panic. But uh, you really couldn't tell that by looking at the KRE and the KBE indexes. Moving on, let's go to where bonds are. BND down today. Clear bonds have reflected a big jump up in price, meaning a big panic, and that resulted in money flowing into bonds. So the yield came down as everybody was piling into bonds. It's just a supply and demand. It kicks up the price, which drops the yield. So there's the broad bond index, the junk bond index, not acting in line with the other bond indexes, but that's to be expected because it acts more like stocks. But it did get the bounce today. Uh, LQD corporate bonds also down today, and TLT, the long term, well off of the highs and down 1.64% today. So that means that yields, which came down to an extreme degree because of money flowing into bonds. Again, we've been talking about this island top, but I certainly didn't expect this huge sell off. We did bounce at the 200-day moving average off of the low yesterday and continued up today. This was kind of expected. The action in the bank stocks, not as good as this. So if the bank stocks had finished half of the way between the candle from Friday, the recovery, I would say, is well underway, which it is appears to be for bonds, but not yet for the banks. Let's go to the 10-year TNX, and not quite inside the second day yet, but this 10-year sell-off was even more harsh. Did bounce at the 200-day moving average and up 3.5%, which is a big move in yields. But again, down from 40 to 34, 35-ish over a couple of sessions. You're certainly going to go in the opposite direction at some point as the rubber band gets stretched to the downside. Let's go to precious metals now, which saw a lot of money flowing into them the past 2 days during the panic inside day today, not giving much of it back. Uh, Important to note that. So GLD with an inside day today. GDX gold stocks making a higher high. So also important to note that. And SLV down on the day, giving back some of the big 2-day bounce off the lows, and Bitcoin still up 3.27%, well off the highs of the day, but money continuing to flow into Bitcoin over the last 2 days as people have been taking a look at it as an alternate way to store money, which is, hey, that's what the Bitcoin folks advertise it as. So those are the major indexes. Let's go to the tail of the tape now. Stochastic indexes, we got basically 4 of them at neutral, meaning they're oversold, but they're trying to hook back up. The Q's very healthy, the exception. G6, all looking negative on a stochastic standpoint. NASI RSI, we're looking for this to flatten out and turn up. Dollar under the 21, still rebounding from the panic in the TNX and TNX. See where the VIX is, we're operating under the bear case with us being under that 200-day moving average. Note that line in the sand from that 3.2 low, which is where we bounced at the 200-day moving average on January 2nd. We got above that, failed back below it today. So need to get back above that and the 21-day to get this rally going again, broad rally anyway. Some news, CPI came out mostly in line. We're already up less than 1%, but we're up strong on the futures. And the futures took off to the upside after that CPI came out. It was mostly in line. The core was off by about 0.1%. But any continued fears about rampant inflation, that just didn't materialize during the numbers today. Day count from down 2 with 1 consolidation to up 1, as I said, 6 days beneath the ADMA and the 21. Rate odds leaning back toward the 25 basis point camp with a 77% chance of that, 23% chance of 0 raise. We're still negative on expectations with volatile intraday trends. That's negative as long as we're under the 200-day moving average on the S&P. As I said, NASDAQ 100 showing volatility, but certainly outperforming the rest of the indexes. 11 out of 11 sectors positive today. Dollar basically flat, closed flat, was up a little bit on the day, faded late. The only down sectors, gold and silver, and airlines, as UAL warned. They had an upbeat earnings report a couple of weeks ago, but now they warned for the upcoming, which is a little strange. Here's the focus list, including SOXL, which we added to, First Solar, which we added to early, and then some other ones that we're going to take a look at in their charts. But early on, we added to First Solar, came out of the chute like gangbusters this morning. Let's look at the 5-minute chart of this. But then it kind of faded. So when we broke above this and the volume was heavy, we added to it. When it broke above this first 5-minute candle here, it doubled up from 2% to 4%, and it started to sell off and bounce, and really was kind of weak all day. And frankly, a disappointment. I expected better from this before the late move higher. Let's look at the daily chart. It still is one of the best looking charts that you'll see out there after the 5 days up. Uh, Including the big volume gap up on its earnings report, which included a big increase in their EPS estimates going forward. So what else did we do? I talked about how we added to QLD and semiconductors, and then how we put the SDS on when we failed around the 200-day moving average. So we ended up having the same basic exposure between the hedges and the longs that we had when we came into the day at 0.17%. So the bottom line, gap up on CPI, harsh reversal down when we hit the 200-day moving average, but then we squeezed up into the close. Let's see what tomorrow brings. Never a dull moment, certainly, in this market. Let's take a look at the rest of the focus list now. We'll start off with TMDX. Great story here. Nice recovery off of the lows the last 2 days, reclaiming the 21-day moving average. ANET continues to be one of the best acting stocks in the market. Look at that relative strength line as well as the price average, just doing everything that we wanted it to. Palo Alto passed over again so there's 3 stocks have been added to the S&P 500 over the last week. Palo Alto is a prime candidate for one of those spots, but didn't get it. And maybe that's why it sold off today. Other security stocks were holding firm. Still a nice consolidation after its earnings gap up, but a bit disappointing after this failed break higher on 3-3, still holding above the 21-day moving average, however. FOUR, payment stock, closing near the low of its range today, still acting fine, holding on to the ADMA. NVIDIA had a very strong day today, along with the rest of the semiconductors. We stopped out on this when we got back to break even on our position on 310. Didn't get back into it, but got into SOX L today, as I mentioned. Mercado Libre, Melli, nice day today, breaking back above its 21 and the 1200 level. AEHR, new client announced today. Closed mid-range, was up almost 10% at one point, but still held on to a 7% gain. Couldn't stay above the declining 21 day. Tesla had a strong day today, bounced off the 21 yesterday, right into the declining EMA. Sorry, bounced off the 50-day, not the 21. Hasn't been able to get back above, but note from oversold, the stochastic has crossed above it. We will get back into this if it gets back above the 21 day. And finally, ITB, home builders. Lennar with a well-received earnings report after hours today. Let's see if it holds today, but these are holding up pretty well. Michael's researched this group and has a very favorable opinion on it. This is really a contrary play. People thinking with the index or with interest rates rising that home builders can't do well, but this is forming a really nice cup and handle, and we're keeping our eye out for putting some money to work in that sector, and that's going to wrap it. As always, like to hear from you. Emails don@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. Remember, it's not how much you make in the markets, it's how much of that you can keep. There's times when the market's healthy There's times when it's unhealthy. Right now, extreme volatility, the only thing healthy is the NASDAQ 100, semiconductors, and a few other sectors that are pretty much going sideways as opposed to going down. Financials at a major risk right now. And that's going to wrap it. I will end up Tuesday, March 14th. This is Don Vandenbord telling it like it is. As I said, it's not how much you make in the markets, it's how much of that you can keep. Reach out to us if you have any questions. Thanks for listening and have a great day.